Hey guys, and welcome back to another Money Tip Monday. My name is Lizy Hofer, and I'm a residential loan officer here in the Phoenix area, and I teach practical money tips to help you make smart home purchases. Today on Money Tip, I want to talk about a very highly debatable topic, especially on this channel, about how you can pay off your mortgage using practical money tips versus velocity banking. Now, I've done a couple videos on this in the past, and some were well received and others not so well received, but today is all about actual practical strategies that have nothing to do with velocity banking. So before we get into all of that though, I am gonna ask you to like, comment, and subscribe to this awesome channel so you don't miss a money tip in the future. Now, for starters, I think it's fair to say that this video is not about criticizing velocity banking. It's a strategy that a lot of people have used to pay off their mortgages, and if it has worked for you, that is awesome. This video is intended to give practical strategies that have nothing to do with that, because there are some people who just want to pay off their mortgage without having to apply for a line of credit or a 0% interest credit card. Now I'm gonna hop into those strategies, but before we get into that, I do wanna explain what the heck amortization is, because if you don't understand that principle, understanding how you can accelerate your principal reductions through additional principal payments won't make any sense. So the technical definition of amortization is that it's the process of spreading a loan out into a series of fixed payments. So in mortgages, a mortgage can be a 30-year fixed, it can be a 20-year fixed, a 10-year fixed, a 15-year fixed. I've seen some companies offer 25-year fixed, and then a couple of years ago there was a, whatever you left off your mortgage at solution. I don't see a whole lot of those advertisements out there, so for the sake of this video, we're gonna assume that mortgage amortizations are 30-year, 20-year, 15-year, and 10-year. So the first practical way of paying off your home quickly is just to get a shorter amortization. And I know that that's probably gonna be like a duh, if I get a 10-year mortgage, of course my mortgage will be paid off in 10 years. But that's honestly one of the most practical strategies that you can do as a home buyer to make sure that you're paying your home off in a timely manner. So for the sake of this video, I am only gonna compare a 30-year and a 15-year, but I think it's fair to say that most consumers don't have a real idea of the money that can be saved by doing a shorter term, if they're able to do so, right? I think that in general, most consumers know, hey, there's a 30-year fixed product available, I'm gonna apply for that. And then most loan officers, because you vary in degree with experience level, they may just only give you what you applied for, and they're not discussing some of these money saving principles with you. So just assume like a $200,000 mortgage at 4.5%. So the monthly payment on a 30-year fixed mortgage is gonna be $1,013.37. Now on a 15-year mortgage, that's gonna be about $1,530.99, right? Now, over the course of a 30-year mortgage, you're gonna pay $164,813.42 in just interest, right? That's in addition to the money that you've taken out, right? And so the total cost of that home loan, right, is gonna end up being somewhere between it's gonna be around $364,813. Now, for a 15-year mortgage, right, assuming just the same interest rate, and interest rates are lower for like shorter terms, just an FYI, but just to do an apples to apples comparison, right? If you were to pay the same exact interest rate, again, $200,000 mortgage, your monthly payment would be $1,529.99. The amount of interest you would pay is $75,000, $397.58. I mean, that is literally almost half of what you would pay, and the total cost of your home is $275,398, right? So there is a significant savings, right, in the long run in the amount of interest that you would pay for your home, right, when you go with a shorter term, Okay. Now, in real life application, a 15-year mortgage is going to be substantially less in interest, but there is a higher mortgage payment associated with that. And so because of that, I do believe a lot of consumers just choose to move forward with a 30-year fixed mortgage. You know, I have my own opinions. I mean, the average homeowner only owns their home for 10 years. So I don't know how realistic it is for people to do this, but I do know that if this is your forever home, having a 15-year mortgage definitely makes a lot of financial sense. Now, the next step I want to talk about is probably literally the most practical tip that I can offer you, and it's literally just applying whatever discretionary excess money you have towards the mortgage debt. Now, this could be $5, $10, $100, but you would be surprised how much just even that little amount can do for your mortgage, right? So now this is going to depend on your interest rate and the loan amount, right? So just note that the results here are going to vary a little bit, but if you made $10 over a 30-year fixed period every single month, you would actually knock off somewhere between 9 to 13 months of term to your mortgage payment. That's $10 additional dollars. If you felt pretty aggressive and you wanted to do $25, we're talking about like 18 months to 32 months, depending on your amortization. And then if you could do $100 a month, we're talking about 6 to 8 years potentially that you would knock off of your mortgage term, right? This is huge. And I don't think that people also understand that a little goes a long way when it's compounded again over a long period of time. So I thought that, I did a little bit of research. I did some math on my own. Obviously, the results will vary depending on your loan amount and your interest rate. But don't be afraid or don't think that it won't matter if you want to put down $10 extra towards your principal every single month. Now, that is something I do want you to note, because when you're making payments, if you pay extra, some banks will apply that towards interest. You specifically have to tell them that any extra payment needs to go to principal. So that leads me into my third tip, which is probably one of the most popular strategies aside from velocity banking, and that is biweekly payments. Now, in order to do a biweekly payment, you have to be ahead in your mortgage payments, because you're going to be breaking apart the mortgage payments and paying half a mortgage payment every 2 weeks, which results in 26 payments, which is essentially one extra payment a year. Now, applying this strategy will knock off anywhere between, again, 6 to 8 years of your mortgage. And honestly, I think it's a really great strategy. Lots of people do this. Not every single bank offers this. There are many banks that do not accept partial payments. So if this is something that you come across, just know that there's a lot of different companies that will process biweekly payments. Make sure that they're reputable, because there are also a lot of scams with this too. So just an FYI, do your research, make sure that they have reviews, make sure that they don't have any complaints, right? Especially those complaints with like the Better Business Bureau. Now, if you like the idea of biweekly payments, but maybe don't think it's as aggressive enough, or you know that you're going to be getting, a large amount of money, either in an inheritance or a bonus or a commission or something, and you'd like to apply it towards your mortgage, you can apply large principal reduction payments. Now, a large principal reduction payment is going to have a major effect on your mortgage because of amortization. Now, what this does is essentially you pay interest on just the balance that you owe every single month, right? But your payment, it always stays the same with whatever the fixed term was whenever you signed your note. So every single month when that payment is due, a larger percentage goes directly to principal versus interest, which is why large principal payments are so important. This is actually a common principle that a lot of velocity bankers talk about, because their philosophy is that if you can, use this 0% interest credit card and pay off your debts, you have like these large sum balances that you can transfer on to your mortgage, right? But you could essentially just save up an extra $1,000 a month, and then once over a year you have $12,000, and plop that $12,000 down at the very beginning of a year, and you can essentially do the same thing. Okay, so large principal reductions, I am definitely in favor for. They're obviously, not a part of some people's budgets. But if you are somebody who has a lot of discretionary money, or you have an inheritance or bonus or commission, this might be a good strategy for you. One of the awesome tips that I actually found when I was doing this research for this video is that one extra mortgage payment every quarter will result in dropping your mortgage term by 11 years if it was a 30-year fixed mortgage. Now, again, I just want to reiterate that is going to vary depending on your loan amount and your interest rate. So my last tip is, I'm almost hesitant to tell you, one, because I'm a loan officer, and two, because I have some conflicting feelings about refinancing even as I work in real estate. So, and I'm going to record a video on that at a later time, but if your finances make sense, right, and you can drop your interest rate significantly and you can maybe drop mortgage insurance, refinancing might be a way for you to pay off your home quicker, right? It can allow you that extra discretionary income to apply towards principal payments. It can also be a time when you shorten your term, which we can see has really long-term benefits when it comes to interest. So refinancing is actually a strategy to paying off your home quicker if you're under the right circumstances. Now, I mentioned that tip last primarily because I'm a loan officer, and this channel sometimes gets some heat because people feel like we're pushing products to you guys because we're salespeople. I personally believe that refinancing only makes sense if you're going to be in your home for a long period of time and there is significant savings, somewhere around $200+ a month, right? So just know that I mentioned this last because I know that that's something that's gonna happen, but it would be wrong of me not to mention it to you in a practical tips for how to pay off your mortgage video. So these are all of my best tips and practices for how you can accomplish paying off your mortgage without any crazy strategies or applying for debt or buying any software. You can do this yourself. It doesn't matter what amount you want to put down. It all makes a difference. If you have any questions on this, want to run an amortization schedule, want to call my team for a consultation, we'd be happy to help you. Guys, again, it is my honor to serve you and teach you these money principles, and I hope that this year is your best year when it comes to money. So tune in next week, guys. We have another great video on money tips.